Well, good afternoon, everybody, and thank you for attending the webinar this afternoon. By way of introduction, I'm Duncan Stewart. I work in the compliance department along with my colleague Hilda, who will also be joining me this afternoon. Look, unlike some, we're not going to subject you to death by PowerPoint this afternoon. So if you need to get up and have a stretch, stick your headphones in and have a wander around, because we're mainly just going to be chatting about the sorts of things we're seeing here in the compliance department around the area of fraud. We'll look at some of the trends and what we see from our role here, and hopefully give you some useful insights into preparing yourself for identifying and preventing yourself becoming a victim of fraud. Like these webinars, please feel free to interact if you've got any questions. If we don't get to them, obviously, we will be able to answer those after the event, and we'll certainly come back to you. So, Hilda, why are we here today?
Thank you, Duncan, and hello everyone, and thank you all for joining us today. So I'm Hilda, and today we'll be talking about fighting mortgage fraud. So mortgage fraud is a reality that everyone will face, and we all do need to be prepared to catch it before it happens. So being mindful and preparing your business in specific during the current environment and uncertain times, which Duncan will talk about a little bit later today. So as a broker, you are the first line of defense, and you do need to make sure that you have risk mitigation strategies in place. So we hope that what we will say today may help you apply some of those strategies to better protect your business.
Sure, Hilda. And look, just by way of a bit of a background as to the way we do things here at Connective in the compliance team, we rely quite a lot on data analytics. We run our own in-house reports, running across like various data warehouses and across the Mercury system. And that allows us to have insights into the types of trends we might be seeing in relation to loan applications. We also partner up with the major lenders, and we receive data, and that allows us to get a more holistic view of what's happening across the trend. And we do this because we're looking for high-risk applications ultimately, and things where there may be concern. Now, those of you that are Connective credit reps would be fully aware that we do reviews, and obviously part of that process is through Mars, and we use that process too to identify things that may be untoward and require further analysis. But at this point, you know, we talk about fraud and why does it occur, and how does it occur, and what causes it? Well, I'm just going to reference a thing called the fraud triangle. You've probably seen it before. It was credited to American Donald Cressy, and he kind of came up with a philosophy that you need three things to occur for fraud to take place. You need pressure, you need rationalization, opportunity. Now, today, as Hilda mentioned before, you know, circumstances, we're in unprecedented waters at the moment in relation to you know, what's going on in the economy, people's employment. And so it's prime time for people to probably behave in a way that they might not otherwise behave. And so there's probably going to be significant financial pressure for people to act differently. You know, people will always rationalize their behavior for or wrongly. Not much any of us can do about that rationalization process. Where you guys come in as brokers and where we come in as Connective is to try and reduce that opportunity wherever possible, you know, and that's by having robust processes in place to try and minimize that opportunity for someone who's going to try and cross the line. One of the things, you know, it would never be a compliance presentation or webinar or whatever it be without some statistics, and not to disappoint anybody here today, because we are nerds, let's face it. Here's a few statistics. We run a lot of investigations, inquiries and reviews here at Connective. Now, of 167 that we did last year, well, that's not all we did last year, but certainly the ones we did had some element of potentially fraudulent behavior in them. Not entirely surprising that 40% of those were in relation to documentary, whether it's confirmed non-genuine documentation or suspected non-genuine documentation. And aside from that, there's obviously non-disclosure as well. And, you know, probably no surprise to anybody any of those. One of the things we do need to bear in mind, of course, when any fraud goes through, potentially there's some ramifications attached to that. And if it's something that should have easily have been picked up, You know, lenders sometimes take a dim view of that, and we had 47 terminations last year in relation to these matters, and 14 warnings issued by lenders. And consequently, that led also to 59 connective warnings and/or terminations. So look, there are consequences, but if we can try and build a good process, then hopefully we never fall into these statistics.
Yeah, absolutely. And that brings us on to how is loan fraud perpetrated. So as you can see from the statistics there, the highest percentage is the non-genuine documentation. So we see a lot of fake pay slips, bank statements and savings, or really just any other documents that can be manufactured. As Duncan mentioned, we also see non-disclosure. So things like your undisclosed debts, dependents, and etc. Those ones are a little bit more tricky to identify, but if you keep an eye out on the details, and obtain documents such as your credit checks, your credit cards, bank statements. These are the things that should reveal most of that information for you. Another type of loan fraud, which we don't generally see that often, is identity fraud, which is obviously someone pretending to be someone that they're not. It's definitely a time to be more vigilant at the moment, as Duncan mentioned, with the current environment, we can't hold face-to-face meetings, which does create more of an opportunity for identity fraud to occur. And also, whilst it's not at its purest sense, shadow broking is also seen as another form of identity fraud. Banks see this as someone pretending to be the broker and potentially using their lender IDs. So whilst you might have an admin person that's using your codes with the best intention, lenders have little to no tolerance for this, as they just see it that they're acting as the broker. So don't get inadvertently caught up in a shadow broking situation. As you know, it's a fine line between providing credit support and providing credit assistance. What you can do is make the rules and responsibilities within your business very clear, and most importantly, don't share your broker codes or login details.
Absolutely, Hilda. One of the other things we do see a little bit, but not much, is contract fraud. You know, there can be unrelated parties in contracts. There can be people that don't make sense to a particular deal. It's not something we see a lot of, but it's, again, does it make sense? Do all the parties to the contract make sense? Does it look like someone's getting favourable terms? Are there any conflicts of interest? Just things to bear in mind, you know, adding a level of healthy skepticism to what you're doing.
Yeah, definitely. And that brings us on to who can perpetrate loan fraud. So the first and most obvious would be your client. Now they have the most opportunity to do this, and they've also got the most to gain. As Duncan mentioned before, is there a conflict of interest there, which also brings it to your referrer. So if they're a paid referrer, there might be a conflict. So you want to think about why are they referring, know who they are, and also do you trust them? And do you have the appropriate referral agreements in place so that you know the business that you're accepting those referrals from?
Yeah, look, absolutely, Hilda. And one thing, obviously, for Connective Credit reps as well, we do require a copy of your referral agreements if you've got referral partners there. So just something else not to forget. One of the other things, other third parties can get involved. It could be as somebody helping out a relative, or somebody who can't speak English as well. Again, does their involvement make sense to the dealings, to the deal? You know, again, just being mindful of what they might have to gain out of it.
Yeah, definitely. So you want to think about their motivation and why they're doing it, which brings us on to why people perpetrate loan fraud. The most obvious reason would be the financial benefit, or they might be funding an addiction, or they might be trying to increase their borrowing capacity. They might desperately be wanting a particular property, or they might have the money later, but the bank won't actually lend it to them based on their current circumstances. There's also instances where income will be coming through, won't be coming through traditional financial assistance. So for instance, someone who's being paid cash, which works fine until they need to get a loan from a financial institution and have to provide those supporting documents. There's also been gambling addictions that are funded mostly through refinance and top-up applications. So we touched on a little bit about what we see at Connective, but Duncan, what are the most commonly seen issues at Connective, in specifically relating to supporting documents?
Yeah, sure, Hill. Look, certainly from my time, and it's been here 2.5 years now, a lot of it has been around income, income and employment. Is income genuine? Is the employment genuine? I mean, does it actually exist? Is it fake? Then followed by bank statements. Bank statements can tell us a lot for lots of reasons. Certainly from a fraud sense, we see altered bank statements, we see manufactured bank statements, we see combinations of all of those. It could be a genuine bank statement, but with the incorrect names on it. So those are the sort of things we see quite a lot here. Fake pay slips or altered pay slips. Again, things to be looking out for all the time. Do they look genuine? Does it make sense to the transaction? Does it make sense to the employment? And also referrals. We've seen more than a few brokers get tripped up by getting some very, very poor business through referral partners. Again, so that comes down to and Hilda will talk a little bit more about that later.
So Duncan, you mentioned bank statements and pay slips. So what is it that we look for exactly when we review those documents? Yeah,
sure. We'll put one on the screen if you are actually watching. But there is no one ideal payslip. Payslips are what they are, and they're what a company wants to issue. But there's things to look out for. There's really obvious traps. You'd be expecting to see names and addresses of the employee on there, some ABN potentially of the company. You'd be looking at breakdown of the earnings for the pay period, for instance, if they've got any sort of deductions coming out. All of those things should be consistent across the pay slips for the pay period. So if you've got 2 or 3 pay slips, you'd expect things to follow through. Things like annual leave, balances, are they going up for the 2 or 3 pay slips you've collected? Or have they gone down? Is there a superannuation amount in there? Is there a superannuation fund? Is there a account where the money's going to? Does that account have a genuine ABN number, BSB number on it? And where the money was deposited. So just little things to think of. There should be summaries on there. As I say, it's a really tricky one, but again, sometimes holistically, when you're looking at pay slips, you get a better feel for it, particularly through referrer business as well. If you suddenly start to see a lot of the same pay slip, but these people supposedly work at different places, could be a bit of a red flag, which leads nicely into some of the red flags.
Yeah, definitely. So some of the red flags to look out for, definitely always keep an eye out on your client's behavior. So are they unwilling to provide you with the original documents? And when they do provide you the documents, are they of poor quality, which makes it even harder for you to verify the information? When you're doing the checks on the employer, is there no website? Is there no office or a location? Generally, you will find something, whether it be on the, the white pages or a Google search. Also keep an eye out on the income. Is it too high for the occupation? So does it seem reasonable? A simple Google search of the average for a specific occupation should give you a good idea of that. And also, is there a potential conflict of interest? So are there any related parties, or is there anyone sharing an office, or is the person providing the gift letter the builder? So what you're doing there is looking for links between parties where it wouldn't usually make sense.
Yeah, absolutely, Hilda. Look, another couple of things that we do see from time to time, and I guess it goes into how do people do things, why do they do it, what's the benefit? But inflated income, we quite often see statement of balances that far exceed what would be usual, and then we get them verified and you find out they're inflated and they're in fact non-genuine. Same with savings. Again, it takes a fair amount to do that, but we do see it. Very occasionally, it's not beyond the realms of possibility that people will actually try and launder funds through a mortgage or through a property. For those of you that got any interest in money laundering, there's 3 main parts to it. It's the placement, the layering, and the integration piece. And that's trying to get, I guess, ill-gotten gains into the regular financial system to make it look clean. And from a broker perspective and from an aggregator perspective, I guess we're in the layering and the integration pieces that someone will be using some funds potentially as a deposit. Really hard to pick up, but again, it's just something to bear in mind, their behavior throughout the transaction. As we've talked about statements, it's a favorite of compliance to talk about statements. There is one on the screen here. There is no, I guess, no exact science to statements. Each lender will have their own format, but just things to look at on the statement. I mean, first and foremost, there's some real obvious ones, like does the logo actually match what you expect to see for the lenders? And we all get used to seeing logos. But we've seen some shockers where it's not even the right colour, but it's passed through. So don't get caught up like that. But making sure things do align. If you've got a payslip and it's got the BSB and the account number, and you've got that transaction statement, make sure those marry up with one another. Make sure the customer details are on there. Is the BSB number on the statement actually a real BSB number? We see plenty of that where they're made up statements, but they fall over on really simple things like the BSB number is just not correct. Account names not being correct or not being ones for that particular institution. But then getting down into the transactions, obviously you'd be looking at those transactions whilst verifying people's living expenses and the like. But looking at the salary one particularly, we found a lot in the last probably 12 months of what they call staged wages, is where somebody might be earning money legitimately, in inverted commas, out there, but they're not getting pay slips, or they may be getting paid in cash. All of a sudden, when you need to get a loan, well, you need to prove that you've got a regular income coming in. So for the period leading up to that, there will be money going into that account, but it won't look like a genuine salary, which would normally have the word salary or wages somewhere in the transaction, and probably a reference number, potentially even a company name in there. The ones we're seeing generally would look like cash deposits or transfers from another account. Again, not always easy to pick up, but something just being vigilant, does it make sense? And particularly in statements as well. If people have added extra lines in to look like there's pay coming in and they've manufactured them, the balance, sometimes don't check the running balance, so it doesn't add up. Just things to bear in mind.
Yeah, good points, Duncan. And bank statements are such an important tool for brokers, and that's why they are made mandatory for Connective Credit representatives. So although it's not a mandatory requirement for all lenders, we do highly recommend that you obtain transaction statements on all your applications. The whole process can be made easier now with the bank statement technology, and as you may be aware, CashDeck is also now available via Mercury. Bank statement will provide you a wealth of information about your customer. So you might even identify things that the customer has not declared or has forgotten to declare to you. So things like your childcare payments, school payments, undisclosed debts, credit cards. And of course, they are an invaluable tool for verifying your customer's living expenses. And they also allow you an opportunity to ask your customer more questions so you can get to know their financial position better.
Yeah, for sure. And look, another one is tax returns. Tax returns are a great way of looking to see not only what people earn, but also do they have dependents, are they married, single, etc. So just something else to think about.
Yeah, definitely. And further to that, Duncan, we've actually just had a comment on chat here through Alex, who he said he obtains super statements to support his application. So that's also another tool that works really well. And whilst it's not mandatory, again, if you do ever have suspicions about an application that you're working on, you may want to obtain copies of the superannuation statements. They can be very revealing and are so heavily detailed, it makes them harder to be manufactured.
Yeah, for sure. Good point.
So some of the red flags to look out for when you're reviewing bank statements. So as mentioned before, when reviewing any document in general, and just during the whole process, you want to keep an eye out on your client's behavior. So if they're unwilling to provide you copies of the original statements, why is that? And when they do provide you the copies, is it a poor quality? As Duncan mentioned, you want to be able to review those documents and make sure you would see what you would expect to see on a bank statement, being your client's name, account number, and if it's of poor quality, you won't be able to do that. So you want to look at, does it look genuine? Does the logo look right? Does the color look right? And look at the fonts and alignments as well.
Yeah, absolutely. And some real good points there. So what can we all do to minimize fraud? Well, yeah, wherever possible, cite the original documents if you can. Not always possible, but wherever you can. Source documents are great and usually the first point. As Hilda mentioned before, use the bank statement scraping technology. And obviously we've got CashDeck available through Mercury, but there's others out there as well. Now, if possible, have the client download documents, such as their pay slips or bank statements when you're with them, either in your office or in their office at home from the internet. That way, you know that it's come from a genuine source and it's not been tampered with. Always collect from your client. try and avoid getting into the trap where either a third party or a referrer, whether it be the accountant or whatever, or a friend passes it on. That can always be problematic. Should something go wrong later down the track, that customer can walk away and say, well, I didn't actually pass those to you, and all of a sudden it leaves you with egg on your face. So again, things to be mindful of. Review the documents, look closely for anomalies. I talked about, bank statements. We look for things that just aren't right. But again, as Hilda mentioned, there's font sizes, there's colors, things that just don't look right. Other things you can do is look at doing Google searches. That can be just a really simple thing. I Google a company that I see on a payslip and I go, okay, never heard of them before. I've lived in this area for a long time. Then do a street view. Now, we've had more than one instance where someone claims to work at a particular place and we've either physically done a site visit or we've actually street viewed and it turns out to be an empty or a vacant block. So it doesn't make sense. Things you don't want to get caught out with. And ask for additional documentation. There's the ATO notice of assessments. And as Alex mentioned earlier on in the chat, super statements, a great way of verifying information.
Yeah, that's great. And I might just mention that we do also have a fraud detection toolkit available for you with all this information. And it does contain some really good tips for identifying a non-genuine document. I won't go through all of them now, but some of the stuff on there include looking out for incorrect spelling or grammar on a document, payslips or tax documents having rounded figures. And a really good one is checking if an ABN is registered for GST. We've had instances before where someone's earning 75,000 a year and the employer is not registered for GST, which doesn't quite make sense. And of course, as part of minimizing loan fraud, the most important aspect is knowing your customer. So as we mentioned before, you want to look at their behavior. Are they avoiding meeting you face to face? Or are they not providing you with the requested documents? And also, are they trying to rush you without any reason? Does your client seem to be heavily interested in lender policies and processes? So are they fishing for information? And another one to actually think about, and that's a really good one, is does it geographically make sense? We've had an applicant previously that lived and worked in Victoria and approached a broker in South Australia, which definitely raised some red flags.
Yeah, look, and whilst that's not completely out of the question, particular community groups, they do stick together, etc., and that may make sense. Again, sometimes that's where the extra piece of due diligence comes in. In this particular case, there were so many red flags, but because it came through a particular channel, a bit of social engineering went on, let's say. But again, a cautionary tale. And when we talk about knowing your customer, obviously there's the legislative side of that for the AML-CTF, but it's more than just knowing your customer from a legal perspective. It's really about knowing and owning your customer, making them stick to you so that they'll want to use you for everything. And a lender said to me quite early on in my tenure with Connective, when he was talking to a broker, is that he needed to think of himself as a 1950s or 1960s country bank manager who knew everything about his customer. He'd know the children's name, the dog's name, children's birthdays. So things like that. But also beyond that, as if you're visiting a customer at home and you've already got some pre-information. They say they don't have children, but there's swings or bikes in the garden and you trip over some toys on the way in. Again, really red flags there for something to be thinking about.
Good point, Duncan. And just as important as knowing your customer is actually knowing your referrer or any third party involved in that matter. So you also want to look at their behavior, but in addition to that, you want to consider what their motivation is. So if you're getting a referral and the referrer is not getting a fee, think about what's in it for them. Are they getting heavily involved and are they starting to provide your clients documents? And are they also asking a lot of questions about lender policies and processes and what their requirements are? So does it seem like they're trying to get around a specific process? So what you want to do there is make sure you keep your referrers out of the transaction, look them up on the ATO records and do your due diligence checks. So even doing an ASIC banned and disqualified check or just a simple internet search should give you an idea of what the business is like and whether or not you want to accept referrals from them.
Yeah, absolutely, Hill. And look, while we're talking about red flags and things, is that again, there's no exact science to this, but you can almost internally or on paper, that's always good because it leaves a record, but think about it as I'm going through a transaction and I've got a certain amount of things I see, oh geez, that doesn't look right, they were remote to me. they're difficult to get hold of. And you can start almost having a subconscious scoring in your mind as to whether I need to look further into this application. So if you're making that list, it's not exhaustive, but if it's a big business that the person allegedly works for, but the business email has a Yahoo, a Gmail, or a Hotmail, is that really right? Again, a big business, BHP or whatever, and you find out there's no landline phone. Bit of a warning. Minimal credit history, no credit history. Employment history or residential address differs between documents without good explanation. Dates of birth on driver's license or other ID documents differs, again, across documents without good explanation. Poor quality documents generally, and expired identification documents. None of these on their own are necessarily a particular warning sign. When you start to add them together, and if you have your own internal scoring system, may lead you to identify something you wouldn't otherwise have seen. I guess from our perspective, summarizing, it's really important knowing who you're dealing with. Who are they? Who are the referrers? Do the transactions, do the documents make sense? Make sure you stick to your process and lender policy and cover your bases wherever you can.
Yeah, definitely, Duncan. So stick to your process. Don't get adversely selected because you're the one who doesn't have a thorough process or controls in place. As Duncan mentioned earlier about the fraud triangle, you don't want to give people the opportunity. Also collect and verify. So critically assess and verify the information, including making that red flags checklist and mitigate those risks. So it's more than just collecting the documents. It's very well to have the information, but if you have the information and don't use it, it can actually be worse than not having it. So knowledge is power there.
Yeah, it sure is. And look, ask lots of questions. Don't be afraid to keep asking until you get the information you want. Anybody that's really trying to get one over on you won't want to answer too many questions, because once you've told a lie, you've got to remember that lie to be able to continually repeat that lie. So again, don't be afraid to say no as well. If you get a transaction, someone's really not playing ball, the deal you walk away from is sometimes the one that saves your career. And of course, it wouldn't be a compliance presentation without talking about making notes. Make loads and loads of notes, because again, they're your friend when things turn pear-shaped at the end. If you've got a good process and you document that process, that stands you in really good stead moving forward.
Definitely good points there. Thank you, Duncan, and thank you again, everyone, for joining us today. So just a reminder to log your CPD points into the register for today's session. If you've already asked some questions in the panel there, we will make sure that we get back to you directly for that. Otherwise, if you have any further questions, please feel free to email us at compliance@connective.com.au or just contact your local CSM. Thank you.
Yep, thanks for your time, everyone.